All right, so learning objective 2 here is about preparing a flexible budget report. So it is a type of report that's used by management, and it provides better information because a flexible budget report actually provides data for various levels of activity, where a static budget only gives you one level of activity, right? But what if you actually had a flexible budget where you actually had a series of basically static budgets at various activity levels, 5,000, 6,000, 7,000 units, and thus you can compare it better, okay? So, so this is much more useful because it helps to identify the changes and it helps you understand whether you really are under budget or over budget, if it's favorable or unfavorable. And so that's basically what we'll be learning here. Okay, so let's start off with an illustration for Barton Robotics. Okay, this is a static budget report based on 10,000 units and only 10,000 units. Okay, because that's what static budgets do, only one level, right, of activity. So at 10,000 units, their budgeted costs are listed here for your variable and fixed costs here, $1.1 million. Well, what if you produce 12,000? All you've got, as we mentioned in Learning Objective 1, all you've got is a static budget for 10,000. Okay. So obviously when you go ahead and compare these numbers, of course you've produced more. So you're going to have higher costs in the areas that are deemed variable costs. And of course, all this is going to be, it's going to look very, very unfavorable, right? It's going to look like you've spent $132,000 more in costs than you budgeted for. But that's a problem. That's not accurate, right? Because the budget is based on 10,000, not on 12,000. So how can you compare? How can you compare and know for sure what the differences are if you're comparing a budget to produce 10,000 with actual numbers that you produce 12,000? Well, that's where this type of a flexible budget report is handy, because what you can do is you can prepare budgets at various activity levels, including one for 12,000 instead of 10,000. So, it's really meaningless, as your book was saying here. It's not relevant to compare production costs for 10,000 units with 12,000 units of actual, of actual production. So it's really not the best way to find out if you're doing well. The best way is to produce a flexible budget where you can actually see what you're budgeted for at 12,000 units and what actually happened at 12,000 units. Okay. So the first thing here is you have to figure out what the costs are on the budget that's based on 10,000. So based on 10,000 units, you had indirect materials of $250,000. Well, divided by 10,000 units, that's $25 per unit is the budgeted amount. For indirect labor, you budgeted $260,000 in total to produce 10,000 units. That's $26 per unit. Again, per unit, important. And in the original budget, utilities was budgeted for $190,000 to produce 10,000 units. That's $19 per unit. So each unit, literally, based on a $10,000 budget, would have cost $70 variable. Of course, your fixed costs don't change. Well, now that you've actually produced 12,000. Can we update the numbers, please? Yes, we can. And so let's update the numbers now in our budget based on 12,000 rather than 10. So you already have the variable costs analyzed here. $25 for indirect materials times 12,000 units would have given a budget of $300,000. Okay. $26 in labor times 12,000 would have given us a $312,000 budget. And utilities would have came in at $228,000. 840 is the total of these three numbers. So why don't we compare what a budget for 12,000 units would have looked like compared to an actual 12,000 units being produced. So now we can actually look at a budget for 12,000 and compare it really with the actual amount. Of course, we already know all of these numbers because they were given to us in the previous illustration. But now what we have to do is rebuild our budget based on the 12,000 units instead of the 10,000 it was simply based on, right? So now 12,000 times each of these numbers is going to give us the answer. So look at our variable costs, okay? Of course, there's going to be no change in fixed costs. Fixed costs are going to be the same regardless how many units we produce, okay? But look at our variable costs. We actually, at a $12,000 production level, our budget would have been $300,000 for materials. We only used $295 for materials. That's $5,000 in costs that we saved. That's favorable because that cost would have been less. And so that's a favorable difference because we saved money for the company. Remember, when we look at costs, if we're under budget, it's a good thing. It's a favorable outcome. The previous budget we looked at favorable was sales. Sales, you want to make more than what you budgeted. Here is costs, so you want to do less. No change in labor, but as you see, utilities, we actually had a $3,000 favorable, right? We budgeted 228, we actually spent 225. We spent 3,000 less than what we thought our costs would be. That's a favorable outcome. So total variable costs ended up basically being $8,000 less than what we thought they would have been. That's a favorable outcome. Okay. So the last part of this is actually developing one of these things. And there's a case study in the book that sort of goes through all this starting on page 418 and 418 going over to 420. Don't start smoking when I say that number. But that's those are the page numbers. Okay, don't get any bad ideas about this one here. So the first thing we do in developing the flexible budget is we have to identify the activity index and what's the relevant range. So like I said, if the factory is capable of producing 20,000 units and you think you're only going to produce 10,000 units, well, what if you produced a little bit less? What if you produce a little bit more? You should have budgets for all of those activity levels within the relevant range. So 40% to 80% of the relevant range. So if the most you can do is 20,000, then the relevant range would be somewhere between 8,000 and 16,000, because 8,000 is 40% of 20, 16,000 is 80% of 20. And so between 8,000 and 16,000 would be a relevant range. You should be doing static budgets for each of those maybe by the thousands, 8,000, 9,000, 10,000, 11,000. You should be looking at all that within the relevant range to do a budget. Okay. You identify those variable costs to determine the budgeted variable cost per unit, so you can build your budgets on different units. Right. Identify the fixed costs and determine the budget amount for each. So that's fixed costs are going to stay the same regardless of the level of activity. And then prepare budgets for those increments. Yeah. And so that's what you're going to see here. So we're going to do here Fox Company. Fox uses a flexible budget for monthly comparisons of the actual amount that happened and what they had planned for budgeted amount for overhead costs in their finishing department. Okay. The master budget showed the expected annual operating capacity was 120,000 direct labor hours. Okay, direct labor hours, and the following costs. So the variable costs here, listed here, fixed costs listed here. So we know that basically we're going to be looking at various direct labor hours, okay? And our relevant range in our case here for this company is between 8,000 hours to 12,000 hours of direct labor per month. Okay, that's the relevant range. So that's the first step. The second step is now to do your variable costs per unit, So if you know from the previous, you had 120,000 direct labor hours, you're going to divide that into each of your variable costs. And so for indirect materials, 180,000 divided by 120 hours, $1.50 per labor hour for indirect materials. Indirect labor, $2. Utilities, 50 cents. Total variable cost per labor hour, $4. $4. Fixed costs. Well, here they have 3 fixed costs per month, and they're not going to change: depreciation, supervision, property taxes. They're the same. And then here it's going to ask us to prepare the budget based on, in this case, prepare in increments of 1,000. Okay, so you have to remember, going back to the first step, the relevant range was between 8,000 and 12,000. So we're going to do literally 5 budgets: one on 8,000, one on 9,000, 10,000, 11,000, and 12,000 hours. So there's 5 different budgets that are going to be prepared based on this. Okay. So here is our flexible budget at various levels of labor hour activity: 8,000, 9,000, 10,000, 11,000, and 12,000. Again, your fixed costs are the same. We don't have to worry about that. What we're worrying about is calculating the differences in the variable costs when we have all these labor hours. That's why we went through that little exercise of getting the cost per unit and per labor hour for indirect materials, indirect labor, and utilities. So now that we have these, we're simply going to multiply them and fill in our cells here. So 8,000 times $1.50, 8,000 times $2, 8,000 times 50 cents. So to produce, to have 8,000 direct labor hours, we'd have $32,000 of variable costs, 30,000 in fixed costs, total costs of 62,000. Again, we would do the same thing for every single column. And again, notice how the more hours we're putting in for labor, Our variable costs are increasing based on the number of labor hours. Fixed costs stay the same. Total costs increase based on the change in the variable costs. Okay. So this is important. This is important. And this is on page 419. Page 419. So we can use a formula. Give me the formula, crabs. To get our total budgeted costs. In this case, our fixed costs plus our variable costs would be our total budgeted costs. Okay. And again, the variable costs is going to change based on the activity level. So what we know is what we know from the previous budget that we looked at. So let's determine, right, the total cost here for Fox manufacturing. Fixed cost is 30,000. That's fixed. Variable cost is $4 per labor hour. What if they had 9,000 direct labor hours? Well, their fixed cost is going to be $30,000. That's the fixed cost. What's the variable cost going to be? It's going to be 9,000 hours times $4. Those two numbers added together are the total. So total of 66,000 in budgeted costs if it's 9,000 direct labor hours. What if they only used 8,622 labor hours? Well, again, the fixed costs are not going to change. This 30,000 is going to be the same when we move it down here. The $4 per hour is not going to change. What's going to change are the hours. Instead of 9,000 hours, we're going to use 8,622. And so our costs would be now 64,488. That's our budgeted costs for that level of production, that labor, that level of labor. Okay. So in essence, what you see here is it's a graphic. It's in your book on page 420. And again, the difference between 10,000 and 12,000 is here in terms of labor hours. Here's the 10,000 down here. Here's the 12,000 down here. And as you see, the budgeted fixed costs are going to be the same regardless, 30,000. That's why that line is flat. Okay. Where it starts going up is when you add those variable costs at the level of labor hour. So at 10,000 hours, we projected that we would have this much, around $70,000 of costs in total. The 30,000 plus the additional variable costs, which would be about 40. But at 12,000, our costs would be closer to 80. Right? Again, it's 30,000 of fixed costs plus the variable costs would be more in this case. And that's basically how it looks in a graph. Hate to get graphic on you, but there it is. So flexible budget reports are very, very widely used. It's a common thing that people in production departments and service departments will see. It's an internal report, usually only seen by managers, okay? And it's looking at usually production data in terms of direct labor hours or something like this, and cost data for both variable and fixed costs. This is actually used widely to evaluate how a manager is performing. Okay, in many, many industries, managers are going to be part of their job performance is based on how did they do? How do they do in this area? Okay. So what if we look, and this is the finishing department, of that company, Fox, that we've been looking at, right? So here is the budgeted amount of costs at 9,000 direct labor hours. Here are your variable costs, here are your fixed costs, 66,000 total. Well, when it actually came down, this is for January, when January was said and done, the actual cost came in, all right, indirect materials was 14,000. That was higher than the $13,500 that they budgeted, so that's unfavorable here. Direct labor budgeted 18, actual 17. That actually is better. Less labor costs is favorable to the company. Right, less costs to the company. Budgeted utilities, actual utilities, slightly unfavorable, a little bit over. But when you look at all of these added together, right, 1,000 favorable direction, 600 unfavorable. That's a difference of 400 favorable. And so this manager would probably get, a good pat on the back and say, hey, nice job keeping the costs under control. Okay. But of course, what actually did it was labor. Indirect labor was much, much lower. Materials was a bit higher. Utilities was higher. So we have this issue here where this bottom line is very important for some managers. How they are actually evaluated. Okay. So that's basically the deal here. I'm going to go ahead and look through learning objective 2. Do it exercise 2 for learning objective 2, which shows you about Strassel Company and their flexible budget graph. And so here, the fixed cost line and the budgeted cost line intersect at the vertical axis at 36,000. Okay, the budgeted total budgeted cost is 186, which is way the hell up here. Okay, at a level of 50. So here's your level of 50 up here. Okay. Compute the total budgeted costs at 30,000 direct labor hours. So they want to know what the budgeted cost is here at this level. So what we know is we have to figure out the variable costs. Okay. What we know is that the fixed line cost and the budgeted total budget cost intersect at 36,000, and the total cost is 186. So clearly the fixed costs are part of this, but the other part is variable. So that's what we have to focus on here. Okay. Fixed costs are actually the 36,000. So what are the variable costs? 150,000. Okay. So of this 186,000, which is the total, they told you that 36,000 of it was fixed. And the only other part is the variable costs. So the variable costs are 150,000 at 50,000 direct labor hours. So that's going to give us our basis in which to figure out these costs. So that means that direct labor per hour is $3. So they want us to compute what the cost would be at 30,000. Okay. Well, at 30,000, we would have variable costs of 90 grand because 30,000 units at $3 a unit is 90,000. But these fixed costs don't go away. Could add them back in. And that would bring our total costs to 126. Okay. So this is what you've got to look forward to over the next couple of days. Woo-hoo! I hope you get fixed on it. And I hope your life doesn't become too variable. Okay. That's the best I can do today. Sorry. Questions?